You're watching something extremely rare unfold right now in a place most people aren't even looking. Japan's 30-year government bond yield just spiked to levels we haven't seen in over a decade. And if you think that's just a local Japanese problem, you're missing the first domino falling in what could become a global liquidity crisis. This isn't speculation. This isn't fear-mongering. This is a technical breakdown of how one seemingly boring bond market move in Tokyo can trigger forced selling, margin calls, and risk-off chaos across every major market on the planet. Stay with me, because by the end of this, you'll understand exactly what's happening, why it matters to your money, and what signals to watch next. Let's start with what actually happened. Japan's 30-year government bond yield, which has been artificially suppressed for decades through central bank intervention, suddenly jumped. We're talking about a move from roughly 1.8% to above 2.5% in a matter of weeks. That might sound small, but in the bond world, especially in Japan where yields have been near zero for 30 years, this is an earthquake. When bond yields rise sharply, bond prices fall just as sharply. And here's the critical part. Japanese government bonds are considered one of the safest, most stable assets in the world. They're used as collateral everywhere. They sit at the foundation of countless leveraged trades. Now, why does Japan matter so much to global finance? Because for the past 3 decades, Japan has been the world's ultimate source of cheap money. Japanese interest rates have been at or near zero since the 1990s. The Bank of Japan has printed money relentlessly, buying up government bonds to keep yields suppressed. This created what's called the yen carry trade, one of the largest and most important financing mechanisms in global markets. Here's how it works. Investors and institutions borrow yen at near zero interest rates in Japan, convert that yen into dollars or other currencies, then invest in higher-yielding assets around the world. Stocks, bonds, real estate, emerging market debt, you name it. The profit comes from the interest rate differential. Borrow at zero, invest at 5 or 6%, pocket the difference. This trade has been running for decades, and the scale is absolutely massive. We're talking potentially trillions of dollars worth of positions built on the assumption that Japanese rates stay low forever, that the yen stays weak, and that Japanese bond yields never rise significantly. But that assumption is now being tested. When Japanese bond yields spike like they just did, 2 things happen simultaneously. First, anyone holding Japanese government bonds as collateral sees the value of that collateral drop. That means margin calls. That means being forced to either post more collateral or sell positions to raise cash. Second, the yen carry trade gets squeezed. If Japanese yields are rising, borrowing yen isn't as cheap anymore. And if the yen starts strengthening because of those higher yields, anyone who borrowed yen and invested elsewhere suddenly faces currency losses on top of everything else. Let me make this concrete. Imagine you're a hedge fund or a global bank. You borrowed 100 billion yen when the interest rate was 0.1%. You converted that into dollars and bought US stocks or emerging market bonds yielding 5%. Beautiful trade, right? But now Japanese yields jump. The yen strengthens against the dollar because higher yields make yen more attractive. Suddenly your borrowing costs are rising, and the currency move is working against you. Your collateral value is dropping because Japanese bond prices are falling. You get a margin call. You're forced to unwind the trade. That means selling the stocks or bonds you bought, buying yen to pay back the loan, and taking losses on both the asset sale and the currency conversion. Multiply this across thousands of institutions globally, and you've got the makings of a forced liquidation event. And here's the thing. This doesn't stay contained in Japan. The yen carry trade finances positions all over the world. When it unwinds, you see selling pressure everywhere. US stocks, European bonds, emerging market currencies, commodities, everything gets hit simultaneously because institutions are selling whatever they can to raise cash and meet margin calls. This is what people mean when they talk about a global margin call. It's not that every market suddenly became fundamentally worthless. It's that the financing structure underneath those markets is breaking, forcing mechanical selling regardless of underlying value. Now, let's talk about why this is happening now. The Bank of Japan has been the last major central bank clinging to ultra-loose monetary policy. While the Federal Reserve, the European Central Bank, and others have been raising rates and tightening policy, Japan kept printing and kept yields suppressed. But that's becoming untenable. Inflation, which Japan tried desperately to create for decades, has finally shown up. The yen has weakened dramatically over the past few years, making imports more expensive and pushing inflation higher. Japanese citizens are feeling real cost of living pain for the first time in a generation. The political pressure on the Bank of Japan to stop suppressing yields and allow rates to normalize is mounting. At the same time, the math is getting scary. Japan's government debt-to-GDP ratio is over 250%, the highest in the developed world. For years, this was manageable because interest rates were zero, so even massive debt had minimal interest costs. But if yields rise to 2–3–4%, the interest expense on that debt becomes crushing. The Japanese government would be spending enormous portions of its budget just servicing debt, crowding out everything else. This is the debt trap. Low rates made huge debt sustainable, but now rising rates make that debt potentially explosive, and the bond market is starting to price in that risk. So what does this mean for global markets specifically? Let's go through the transmission channels. First, the US dollar. In a typical yen carry trade unwind, you see the yen strengthen sharply because everyone's rushing to buy yen to pay back their loans. A stronger yen means a relatively weaker dollar against the yen, but paradoxically, the dollar often strengthens against other currencies during these events because investors flee to safety. The dollar is still the world's reserve currency and the ultimate safe haven in liquidity crises. So you might see the dollar index rise even as dollar-yen specifically falls. This creates cross-currents and volatility in currency markets. Second, U.S. stocks. American equities have been partially financed by the yen carry trade for years. When that trade unwinds, there's selling pressure on U.S. stocks. You saw this play out in previous mini-crises: August 2015, December 2018, March 2020, episodes where the yen carry trade unwound suddenly and stocks fell sharply. The correlation isn't perfect, but it's real. If Japanese yields keep rising and the yen keeps strengthening, expect more pressure on risk assets, including U.S. equities. The mega-cap tech stocks that have led the market could be particularly vulnerable because they've been favorite destinations for leveraged global capital. Third, bonds outside Japan. Rising Japanese yields create ripple effects in other sovereign bond markets. If Japan is allowing yields to rise, that reduces global demand for U.S. treasuries and European bonds because Japanese investors who previously bought them might keep money home for better domestic yields. Reduced demand for treasuries means U.S. yields could rise as well, which tightens financial conditions in America even if the Fed isn't actively raising rates. This is a form of monetary tightening happening through the back door via global bond market dynamics. Fourth, emerging markets. Many emerging market countries and companies borrowed heavily during the decades of cheap yen and cheap dollars. If the yen carry trade unwinds, those borrowers face higher refinancing costs and potential currency crises if capital flees emerging markets for safer developed market havens. We could see stress in countries like Turkey, Argentina, parts of Southeast Asia, anywhere that became dependent on the flow of cheap global liquidity that the yen carry trade represented. Fifth, commodities. In theory, a global liquidity squeeze is negative for commodities because it implies slower economic growth and reduced demand. We saw copper, oil, and other industrial commodities sell off recently as concerns about global growth intensified. However, there's a counterargument here. If the yen carry trade unwind leads to currency instability and questions about fiat currency stability broadly, that could actually be bullish for gold and silver as monetary safe havens. It depends on whether the market interprets this as deflationary deleveraging or as the beginning of a broader loss of confidence in paper currencies and central bank control. Let's zoom in on gold and silver specifically because this is where things get interesting for precious metals investors. In the immediate aftermath of a liquidity shock, gold sometimes gets sold along with everything else as institutions raise cash. We saw that in March 2020. Gold dropped sharply for about 2 weeks as funds liquidated to meet margin calls, even though logically gold should benefit from crisis. But that selling is typically short-lived. Once the immediate liquidity panic passes, gold tends to rally strongly because the underlying drivers, currency debasement, loss of confidence in central banks, safe haven demand, reassert themselves. Silver often follows a similar but more volatile pattern. It gets hit harder initially because it has more industrial demand exposure and tends to trade more like a risk asset in the short term. But if we're entering a period where the entire post-1971 fiat currency system is being questioned, where decades of central bank manipulation are unwinding chaotically, silver's monetary properties come back into focus. The gold-to-silver ratio, currently around 75-1, historically averages much lower. If gold rallies on monetary concerns and silver follows with its typical leverage, we could see significant moves in both metals. Now, I want to be clear about something. This doesn't necessarily mean immediate collapse or global depression. Financial markets have mechanisms to absorb shocks. Central banks can and will intervene if things get truly disorderly. The Bank of Japan could reverse course and go back to yield curve control if bond market stress becomes unmanageable. The Federal Reserve could provide dollar swap lines to ease offshore dollar shortages. Governments can step in with fiscal support. The system has circuit breakers, but those interventions come with costs. More intervention means more money printing, more debt, more moral hazard, and ultimately more inflation down the road. Each time central banks rescue the system, they undermine confidence a little more and set up the conditions for the next crisis. What we're witnessing might not be the big one, but it's a warning shot. It's a reminder that the entire global financial system is built on a foundation of suppressed interest rates, massive debt, and interconnected leverage. When one part of that foundation cracks, like Japanese bond yields spiking, the stress transmits everywhere. And each stress episode reveals the fragility underneath the apparent stability. Japan's situation is particularly important because it's been the anchor of ultra-loose policy globally. If Japan can't maintain yield curve control, if Japanese yields normalize to something resembling historical levels, the implications cascade through every market on Earth. Let's talk about what you should actually watch going forward. First, the Bank of Japan's policy statements and actions. Are they trying to cap yields again with massive bond purchases? Or are they allowing yields to rise and accepting the consequences? Their response will tell you how serious this situation is and whether it's likely to escalate. Second, watch the yen exchange rate, particularly dollar yen. Rapid yen strengthening, say, a move from 145 to 135 or lower, would indicate serious carry trade unwinding and would correlate with stress in global risk assets. Third, monitor cross-asset correlations. In normal markets, different assets move somewhat independently. In stress periods, correlations go to 1. Everything falls together except safe havens. If you see stocks, bonds, commodities, and emerging markets all selling off simultaneously while volatility spikes, that's your signal of systemic stress. Fourth, pay attention to credit spreads, especially in high-yield corporate bonds and leveraged loans. Widening spreads indicate growing concern about defaults and reduced risk appetite. They're often an early warning system for broader market trouble. Fifth, watch the VIX and other volatility measures. Sustained elevated volatility suggests ongoing uncertainty and forced deleveraging. Sixth, gold and silver price action, but more importantly, physical premiums and availability. If paper prices are falling but physical premiums are rising and supply is tight, that's a major signal of disconnect between paper markets and physical reality, often preceding significant rallies. Now, what should you actually do with this information? That depends entirely on your situation, time horizon, and risk tolerance. I'm not here to give you specific financial advice. That's not my role, and you should make your own decisions or consult with professionals. But I can share how sophisticated investors typically think about environments like this. First, they increase liquidity. Having cash or cash equivalents available means you can take advantage of opportunities when forced sellers create bargains, and it means you're not the one forced to sell at the worst moment. Second, they reduce leverage. If a margin call environment is developing, you don't want to be the one getting that call. Deleverage before you have to. Third, they diversify across asset classes and jurisdictions. Don't have everything in one market or one currency. If the yen carry trade is unwinding, having exposure across different regions and asset types provides some insulation. Fourth, they increase precious metals allocation as insurance. Not speculation, insurance. If there's even a 10 or 20% chance that what's happening in Japan triggers broader monetary instability, Having 5 to 20% of your portfolio in physical gold and silver makes sense as protection. Fifth, they stay informed but don't panic. Markets overreact in both directions. Selling everything at the bottom of a panic is just as destructive as being fully leveraged when a crisis hits. Let me address the skeptics and the alternative view because it's important to consider all perspectives. Some analysts argue that what's happening in Japan is actually healthy, a normalization after decades of distortion. They point out that Japanese inflation is still modest, the economy is growing, employment is strong, and wages are finally rising. From this perspective, allowing yields to rise is simply bringing Japan back to normal monetary policy after an extraordinary period. The yen carry trade unwind, while painful for some leveraged traders, clears out excess leverage and creates a more stable foundation going forward. And the Bank of Japan has enormous resources and credibility to manage the transition smoothly. Furthermore, global markets are far more resilient than in previous decades. Banks are better capitalized. Derivatives markets have central clearing that reduces counterparty risk. Central banks have proven they'll do whatever it takes to prevent systemic collapse, as we saw in 2020. The interconnected nature of global finance means authorities everywhere have incentive to cooperate and prevent contagion. From this viewpoint, Japan's yield move might cause short-term volatility but won't trigger a global crisis. Markets will adjust, leverage positions will be unwound in orderly fashion, and life goes on. I respect that perspective, and it could absolutely be right. The future is uncertain and multiple outcomes are possible. But here's my concern. Every major financial crisis of the past few decades was preceded by similar reassurances. Before 2008, we were told subprime was contained. Before the European debt crisis, we were told Greek problems wouldn't spread. Before the March 2020 liquidity crisis, we were told the system was resilient. The pattern is always the same. Initial stress in one area, reassurances that it's contained, gradual realization that the connections are deeper than understood, forced deleveraging spreading across markets, then emergency intervention. Maybe this time is different. Maybe the system really can handle Japan normalizing yields without broader consequences. But betting everything on that assumption seems unwise given historical patterns. The challenge with interconnected complex systems is that the connections are often hidden until stress reveals them. You don't know which institutions are heavily exposed to the yen carry trade until they start unwinding positions. You don't know which investment funds were using Japanese government bonds as collateral for leveraged bets elsewhere until they face margin calls. You don't know which emerging market borrowers are vulnerable to yen strength until they can't roll over debt. The opacity of modern finance means problems can be much larger than they appear until they're suddenly obvious to everyone at once. And by then, the easy exits are gone and you're selling into a panicked market. Here's the broader context I think matters. We're in the terminal phase of a 40-plus year bond bull market that began in the early 1980s when Paul Volcker broke inflation and rates peaked. Since then, interest rates globally have been on a downward trend, with occasional reversals, but overall declining. That long-term decline enabled ever-increasing debt levels, ever higher asset valuations, and ever more leverage in the financial system. The entire structure of modern finance was built for an environment of falling rates and rising liquidity. But that era appears to be ending. Central banks are now dealing with structural inflation that won't go away easily. Demographics, deglobalization, energy transition costs, geopolitical tensions, all of these point toward a higher inflation, higher interest rate world going forward. If that's the new reality, then assets and systems built for the old reality are mispriced and vulnerable. Japan is the canary in the coal mine because it was the most extreme example of the old paradigm: zero rates, unlimited money printing, yields suppressed by central bank intervention. If Japan can't maintain that anymore, what does that say about the sustainability of the broader global system? Can the European Central Bank keep yields suppressed forever across diverse economies with massive debt burdens? Can the Federal Reserve keep financial conditions loose enough to support asset prices without reigniting inflation? Can China manage its property bubble and local government debt without triggering hard landing? These are all related questions, and Japan's situation illuminates the challenges. There's also a generational aspect to consider. If you're a younger investor, say in your 20s or 30s, your entire investing experience has been shaped by central bank intervention, quantitative easing, and the assumption that authorities will always step in to support markets. You've seen the Fed put, the ECB put, the BOJ put, the belief that central banks won't allow significant sustained downturns. That's created a certain complacency and encouraged risk-taking. But older investors who lived through the 70s inflation, the 80s Volcker tightening, the early 90s recession, or even the 2008 crisis remember that markets can actually go down and stay down for years despite central bank efforts. The lesson they learned is that central banks aren't omnipotent and that monetary policy has limits and creates unintended consequences. What's happening in Japan might be the moment when the younger generation learns that lesson. Not because I want that to happen, but because systems built on unsustainable foundations eventually have to adjust. You can't suppress interest rates at zero for 30 years without accumulating enormous distortions. You can't run government debt over 250% of GDP without consequences eventually emerging. You can't finance the entire global financial system on carry trades funded by one country's artificially cheap currency without creating fragility. Japan's yield spike might be the moment when all those distortions start being reconciled with reality. Let me bring this to a practical conclusion. Whether you're an active trader, a long-term investor, or someone just trying to protect your savings, the key is awareness without paralysis. You need to understand what's happening and what the potential implications are without freezing or making panic decisions. The Japanese bond market move we're seeing right now is significant. It has clear transmission mechanisms into global markets through the yen carry trade, collateral chains, and liquidity dynamics. It's not guaranteed to trigger a global crisis, but the risk is elevated and deserves your attention. What I would suggest is this: review your portfolio with fresh eyes given this new information. Ask yourself honestly whether you're positioned for a world where interest rates stay higher for longer, where central bank intervention might be less effective, where leverage gets unwound rather than expanded, where safe haven assets might outperform risk assets. If your portfolio is heavily concentrated in assets that need low rates and ample liquidity to perform well, consider whether some diversification makes sense. If you have no exposure to precious metals or other hard assets, consider whether adding some as insurance is prudent. If you're carrying significant leverage, consider whether reducing it provides more flexibility. The goal isn't to time every market move perfectly. That's impossible. The goal is to position yourself so that you can survive and even benefit from multiple potential outcomes. If Japanese yields stabilize and this all blows over, having some precious metals and lower leverage won't have hurt you much. But if this escalates into broader deleveraging and monetary instability, those same positions could be the difference between weathering the storm and suffering serious damage. This is about asymmetric risk management, making decisions where the downside of being wrong is minimal, but the upside of being right is significant. Stay informed about what's happening in Japan. Watch the key indicators I mentioned: Bank of Japan policy, yen exchange rate, cross-asset correlations, credit spreads, volatility measures, precious metals behavior. Don't rely on mainstream financial media to tell you when things are serious. By the time CNBC is running crisis coverage, the easy adjustments have already passed. Follow analysts and sources who understand the plumbing of global finance and can explain the connections between markets. Think critically about what you're hearing from official sources because their incentive is always to downplay risk and maintain confidence until they absolutely can't anymore. And perhaps most importantly, maintain some humility about predictions. I don't know exactly how this plays out. Nobody does. The financial system is too complex, and there are too many variables. But I do know that when fundamental structural issues emerge in critical parts of the global financial system, paying attention and preparing for multiple outcomes is prudent. Japan's 30-year yield spiking might be the first domino, or it might be a false alarm that gets resolved quickly. Time will tell. But the potential consequences are significant enough that ignoring this would be a mistake. The margin call scenario isn't certain, but it's plausible enough that your portfolio should have some protection in place. Keep learning, stay flexible, and position yourself for an uncertain future. That's how you navigate periods like this successfully.